Welcome to Mauuak Saving Tips. Put my investment strategies to the test and see if I can survive the next big market crash. Market crashes can be devastating for everyday investors, causing significant financial losses and emotional distress. The impact of a market crash can be felt for years to come, making it essential to be prepared and have a solid investment strategy in place. Many investors are unaware of the risks associated with market crashes and are often caught off guard when they occur. The importance of being prepared cannot be overstated, as it can mean the difference between significant financial losses and minimal damage. By understanding the risks and having a plan in place, investors can navigate market crashes with confidence and come out stronger on the other side. A well-thought-out investment strategy can help mitigate the effects of a market crash, ensuring that investors are protected and able to achieve their long-term financial goals. Market crashes are a natural part of the economic cycle, and they can happen at any time, often without warning. The key to surviving a market crash is to be proactive and take steps to protect your investments before it's too late. This includes diversifying your portfolio, having a cash reserve, and being prepared to adapt to changing market conditions. By taking these steps, investors can reduce their risk and increase their chances of surviving a market crash. The consequences of not being prepared for a market crash can be severe, resulting in significant financial losses and a lasting impact on one's financial well-being. Investors who are unprepared may be forced to sell their assets at a loss, locking in their losses and undermining their long-term financial goals. On the other hand, investors who are prepared can take advantage of the opportunities that arise during a market crash, potentially generating significant returns and achieving their financial objectives. Many investors believe that market crashes are unpredictable and unavoidable, but this is not entirely true. While it is impossible to predict with certainty when a market crash will occur, there are often warning signs and indicators that can signal an impending crash. Investors who are aware of these signs and take steps to protect their investments can reduce their risk and increase their chances of surviving a market crash. Common misconceptions about market crashes include the idea that they are rare events and that investors can simply ride out the storm. Investors often struggle to navigate market crashes due to a lack of knowledge and experience. Many investors are not aware of the risks associated with market crashes and do not have a plan in place to mitigate those risks. As a result, they may make emotional decisions that can exacerbate their losses and undermine their long-term financial goals. Fear and panic can drive investor behavior during a market crash, leading to poor decision-making and significant financial losses. The media can also play a role in perpetuating misconceptions about market crashes, often sensationalizing the events and creating a sense of panic among investors. This can lead to a self-reinforcing cycle of fear and selling, which can drive prices down further and exacerbate the crisis. Investors who are aware of these dynamics can take steps to avoid getting caught up in the hype and instead focus on making rational, informed decisions. Historical market crashes, such as the 1929 stock market crash and the 2008 financial crisis, provide valuable lessons for investors. These events demonstrate the importance of diversification, risk management, and prudent investment strategies. Investors who were prepared and had a solid plan in place were able to navigate these crises with ease, while those who were unprepared suffered significant losses. The 1929 stock market crash, for example, was a devastating event that wiped out millions of investors. However, some investors, such as Warren Buffett's mentor, Benjamin Graham, were able to navigate the crisis and even profit from it. Graham's investment strategy, which emphasized value investing and risk management, allowed him to avoid the worst of the losses and capitalize on the opportunities that arose during the crisis. Other successful investors, such as John Templeton, have also demonstrated the importance of being prepared and having a solid investment strategy in place. Templeton, who made a fortune during the 1930s, attributed his success to his disciplined investment approach and his willingness to take calculated risks. His strategy, which emphasized diversification and risk management, allowed him to navigate the challenges of the Great Depression and achieve significant returns. The 2008 financial crisis also provides valuable lessons for investors. This event demonstrated the importance of prudent risk management and the need to be prepared for unexpected events. Investors who were heavily invested in subprime mortgages and other toxic assets suffered significant losses, while those who were diversified and had a solid plan in place were able to mitigate their losses and even profit from the crisis. One key strategy that successful investors use to navigate market crashes is to maintain a cash reserve. This allows them to take advantage of opportunities that arise during a crisis, such as buying distressed assets at discounted prices. Having a cash reserve also provides a sense of security and reduces the need to sell assets at a loss, which can help to minimize losses and preserve wealth. Diversification is another key strategy that successful investors use to navigate market crashes. By spreading their investments across different asset classes and geographies, investors can reduce their risk and increase their potential for returns. This approach can help to smooth out the ups and downs of the market, providing a more stable and predictable return over the long term. To protect their investments during downturns, investors should focus on essential tips and tricks, such as maintaining a long-term perspective and avoiding emotional decision-making. Investors should also be aware of their risk tolerance and adjust their investment strategy accordingly. This may involve reducing their exposure to volatile assets or increasing their allocation to more stable investments. Investors should also be prepared to adapt to changing market conditions, which may involve adjusting their investment strategy or rebalancing their portfolio. This can help to minimize losses and maximize returns, ensuring that investors achieve their long-term financial goals. By being proactive and taking steps to protect their investments, investors can reduce their risk and increase their chances of surviving a market crash. In addition to these strategies, investors should also be aware of the importance of valuation and the need to avoid overpaying for assets. This can help to minimize losses and maximize returns, ensuring that investors achieve their long-term financial goals. By focusing on value investing and avoiding speculative investments, investors can reduce their risk and increase their potential for returns. The key insight that can change an investor's financial approach is the importance of being prepared and having a solid investment strategy in place. By understanding the risks and taking steps to mitigate them, investors can navigate market crashes with confidence and achieve their long-term financial goals. This involves maintaining a long-term perspective, avoiding emotional decision-making, and being prepared to adapt to changing market conditions. To recap, the main points covered in this video are the importance of being prepared for a market crash, the common misconceptions about market crashes, and the strategies that successful investors use to navigate these events. Investors should focus on maintaining a cash reserve, diversifying their portfolio, and being prepared to adapt to changing market conditions. By following these tips and strategies, investors can reduce their risk and increase their chances of surviving a market crash. The importance of preparation and sound investment strategies cannot be overstated. By being proactive and taking steps to protect their investments, investors can minimize their losses and maximize their returns. This involves maintaining a long-term perspective, avoiding emotional decision-making, and being prepared to adapt to changing market conditions. In conclusion, surviving a market crash requires a combination of preparation, discipline, and patience. Investors who are aware of the risks and take steps to mitigate them can navigate these events with confidence and achieve their long-term financial goals. By following the strategies outlined in this video, investors can reduce their risk and increase their potential for returns. Join the conversation and share your own experiences with market crashes in the comments below. And don't forget to check out my other videos for more investment tips and strategies.